A very good afternoon and welcome to HYCM's workshop with myself, Giles Coughlin, Chief Currency Analyst. It's lovely to have you here. Looking forward to just explaining what's going in the markets at the moment, helping you understand the big picture, as well as we're going to focus on the Bank of England interest rate meeting as well that's coming out tomorrow. A lot of anticipation for that event, and there could be some strong volatility in the pound. I'm going to show us what to look for. I'll explain what I'm looking for. I'll show you how I've traded into the event. I'm also going to show you how I'm trading out of the event. Before we get going, don't forget that as we look at this workshop, the whole idea of this workshop is not a signal trading service. Instead, it is, as it were, you look over my shoulder, you see how someone with a professional trading background makes decisions, how I go about understanding the markets. And of course, I will talk about different entries, exits, different instruments to trade, but I will be doing all that from an educational perspective. So over time, those of you who've been here regularly, you know the score and you know how it works. So the special topic we'll be looking at today is how to trade the Bank of England meeting tomorrow. I'm going to run through that with you. But before we do, I just want to remind us what we're trying to do in these workshops. The key thing we want to discover in these kinds of workshops is we're always looking to back strength against weakness. Now, just as you can see this diagram, you can see a strong arm. The strong arm should defeat the weak arm. We're looking to pair not strong people against weak people, but we're looking to pair strong currencies against weak currencies. And that way, we have the greater probability of direction. So with that being said, let's go straight over the charts because there's a few things I really need to explain to help you understand market dynamics. Now, yesterday I was speaking to a reporter in the US, reporting for the Washington Post and New York Times, and he was talking about equity markets and how high they were and how almost impossible it was to kind of manage these kind of environments. And in many ways, he's right. These are very difficult environments to manage. Now, let me explain to you what's going on here. Now, if you look at this chart over the last sort of 10, 20 years, do you notice how since March 2020 through to the present day, can you see how steep the gains have been in US stock markets? Now, this is the S&P 500. So it's the 500 leading US companies. You see how steep they've been rising. Now, let me explain to you why they've been rising. Now, you might say to yourself, well, hang on, why are stocks rising so high? We've been in the middle of a pandemic. And you'd be right to say that. But the only reason stocks have been rising this fast and this hard is because of the amount of government borrowing. Now, if you were a company in the US and you've had to lay off your workers, the government is helping to support the whole economy, and that money is being lent. And the way a government borrows money, they don't borrow it from a bank because they need huge amounts of money. Instead, they issue what's called a bond. And so the governments around the world have been issuing bonds to borrow huge amounts of money so that they can support the citizens in their country. That's why stocks have been so well supported during the COVID-19 crisis, and that's why they've been buying. Every dip has been bought. Now, you might say to yourself, well, when does this end? Well, let me explain to you. Can you see this very large trend line? And this is what I explained to the Washington Post reporter yesterday, and he really liked it. I said, look, when these kinds of markets, no one knows exactly when they're going to collapse. No one knows exactly when they're correct. So all you can do is find sensible places to define and limit your risk. So you see this trend line is a very simple place to define and limit your risk. Now you might notice, look, hang on, the market broke through that trend line last week. What happened? Was there a specific event that happened? And you'd be right, there was a specific event. Now last week, the Federal Reserve, which is the world's largest central bank, they decided to increase interest, potentially increase interest rates. So what happened was something called a hawkish dot plot shift. In other words, the members of the Federal Reserve saw interest rates rising sooner than they did in the previous meeting. Now, why is that significant? Well, it's for this reason. If interest rates rise, it means that these companies' debts is going to cost more money to service. And if debt becomes more expensive, that means profitability of companies will be hit. That's why equity markets fall. So typically, the relationship to understand is rising interest rates means falling stocks, and falling interest rates means rising stocks. So the thought of the US raising interest rates had stocks falling. Now you notice, now you'll see, look how significant this reversal is on the 21st of June at the start of this week. It's hugely significant because investors have thought, well, okay, there's still no interest rates until 2023. The chances of interest rates rising quickly are quite low. So we can still see the low interest rate environment, the lots of fiscal stimulus, lots of lending money is still going to be supportive for stocks. So we'll keep buying stocks. So how should you manage this? Well, you should manage these kinds of markets. Just use this trend line. And if price stays above, you can stay long. If price moves below, you can go short. It's a very simple way of managing tricky markets because none of us have a crystal ball and none of us know exactly when conditions will change and when this correction in the stocks will come. It'll likely come with a catalyst. It'll be like, the Federal Reserve raising interest rates. So look for this in the future and you will see what happens. When there's hints of interest rates being increased, you'll see stock markets falling. So a couple of things to say, and this is what I was speaking to a reporter yesterday about. Well, is there any point investing in stocks? Now, at these levels, stocks are very, very elevated, but there is one index that looks particularly good. Now, do you see this March 2020, this February 2020 high? Do you see how the S&P 500 has pushed through that level there? Yeah, and it's gone on higher. Look at the Dow Jones. Okay, pre-COVID levels, prices move higher. Now look at NASDAQ. Pre-COVID levels, all the way down here, NASDAQ's pushed higher. Now, why is the NASDAQ pushed higher? It's because of tech stocks, things like Amazon, Facebook, Netflix, Google, the so-called tech stocks. Everyone's been sat at home, haven't they? And because they've been sat at home, they've been ordering things off Amazon, they've been watching things on Netflix, and they've been receiving advertising on Facebook. That's why the FANG stocks, NASDAQ, the tech stocks have been driven higher. Now let me show you the FTSE 100. What do you notice when I show you the FTSE 100? That's the February 2020 levels. What can you see? Well, it doesn't take long to see that those highs haven't been filled yet. Now, this was, I am personally long in a sort of more settled account that I have, less active trading, looking for this gap to fill up to the 7,500 region. So I'm anticipating this area to fall. Now, you might be saying, well, Giles, why has the FTSE 100 not recovered when, say, another European index, let's take the German index, the DAX, that's the 20. Look, the stock market went above those highs. Why has the FTSE 100 not done that? Well, let me explain. The FTSE 100 has also been sold on fears regarding Brexit. Now, there was, heading into the end of last year, fears that the UK would have a no-deal Brexit. And so for the last kind of number of years, the FTSE 100 had been finding sellers because people didn't want to invest in UK companies, because if the UK had a no-deal Brexit with the EU, the environment would be very poor, the UK companies. So investors feared it. Now, the chances of a no-deal Brexit have receded. The UK is one of the fastest vaccinating countries in the world. Around 50% of the entire population now has double vaccines. I've got 2 vaccines, and I'm 40 years of age, so I've got both of my vaccines. We also have around 70% with at least one vaccination. So the UK is set to recover. And I had a friend who was DJing in Israel over the weekend, and in Israel, they're the most vaccinated country, and he said it was completely normal. It was no face masks. Everyone was just walking around normal, and hospitalizations and deaths are low. So remember, the thing to worry about at the moment is not cases alone, it's hospitalizations and deaths, because COVID-19 is just going to be part of the environment. Now, if you just look at a report here from one of our partners, Financial Source, I'll just show you some of those details so you can understand exactly what's going on now. Let me just show you here. And if you look at the amount of vaccinations that have taken place, see, UK around 50%, so around 60% with one vaccination. Now, the thing here is how many people are actually dying of COVID-19. Now, cases are not as important as hospitalizations and deaths. We can't avoid people getting COVID-19, really. It's going to be very hard, but as long as people aren't going to hospital and as long as people aren't dying, cases rising will be tolerated. So this means that the FTSE 100 is potentially set for a nice run high up to that 7,500. Now, where can you define and limit your risk? Well, you can use this very simple trend line. There's two trend lines you can use. You can use this one, or you can use this very simple trend line here. And you can say to yourself, well, look, as long as price stays above 6,800, I'm going to stay long. If it moves below, then I'll exit the trade. So that's a very simple method, and you can potentially look at taking profit up at that 7,500 points. So I'm looking around 400 points, and if it gets up there, you know, I'll probably look at holding it longer, up to 7, 8, maybe even try and gun for 8,000. I'll see how the market environment is in there. I hope that explains to you what's going on. And this is why many investors are becoming frightened because of the speed of this rally. And I was covering Forex Live this morning .com, just covering their European session. Great bunch of analysts over there, really, really understand market dynamics. And I posted this post, which I think will be helpful for you to see, which is a gentleman called Jeremy Grantham, and he was saying, are these the biggest US fantasy trip ever, these markets? He said, look, inflation is a 4,000-year low, and he said that there's bubble signs everywhere, debt and margins at peak, trading volume is bullish, and there's lots of volumes on call options. Now, call options is when people expect higher prices, and over-the-counter penny stocks are at record highs. So in other words, people are expecting, like, they're super bullish. Everyone's thinking this market can't collapse. I've got to buy everything. And these paces of upside can't carry on forever, okay? So just be careful that at some point a correction is expected. Now, don't fear the correction, but be prepared for it, okay? So I'm not long any of these major world indices. The only major world index I'm long is the FTSE 100. And if you want a tip for seeing whether equity markets are going to fall or rise, look at the VIX. Now this VIX is called the fear option, is the shorthand for it. And what the VIX does is it tells you the level of put options in the S&P 500. Now, a put option is something you would execute when you expect equity markets to fall. So when the VIX goes higher, it means that investors are expecting equity markets to go lower. So let me show you. I'm just going to plot the VIX onto this and overlay this chart. You'll understand it. So let's just use that. Okay, let's get rid of the turquoise one, and then that should become clearer for you. Right. So the yellow line is the S&P 500, remember? And we looked at that earlier, didn't we? We looked at the S&P 500. Now this is the same, but it's just a gold line. Now this candlestick chart here is the VIX. Do you notice as the VIX goes up, what happens to the S&P 500? It falls. As the VIX goes up, what happens to the S&P 500? It falls. Now, as the VIX goes down, what happens to the S&P 500? It rises. So if you want to see what's going to happen with stock markets, just look at the VIX. Rising VIX, falling stocks. Rising VIX, falling stocks. Look. Rising VIX, falling stocks. Now you can trade the VIX itself, and you know I've had some very nice trades trading the VIX. If you're expecting volatile prices, you can just go long the VIX. If you're expecting prices to calm, you can just short the VIX. And it's a very simple way. So the VIX at the moment is saying equity prices should keep rising. Look, it's pushing lower, and so we expect equity futures are pushing higher. So that's the relationship that we expect. Now, a very big meeting that we have tomorrow is the Bank of England interest rate meeting. This is the most important meeting of the week. Now, if you've been following along my blog, I have been talking about this for quite a while, and I've been talking about the potential for the Bank of England to taper bond purchases. Remember, when the Bank of England taper bond purchases, it means they're closer to raising interest rates, which means the currency appreciates. Now, you can, let me just see, you can see here, I've been looking at Bank of England tapering all the way since May. So I'm expecting the Bank of England to be, so I wrote this 12th of May, I'm expecting, I published it on the 12th of May, I usually write them a little bit earlier. I'm expecting the Bank of England to be more hawkish. Now, this was the way I've traded it. Now, this is something for you to learn. When you are expecting a central bank interest rate, buy, you can buy into the event. So it's a bit like this. Imagine if I said to you, look, you're going to come to my house and we're going to go swimming. And if you don't have a swimming costume, what are you going to do? You're going to buy the swimming costume before you come to my house. Central bank meeting is exactly the same. So if things are looking, very good for a central bank, you would buy the currency into the meeting. So I bought the pound into this meeting. I was buying it since last week. And you can see here that I've got 3 trades long the pound. I'm long the pound Swiss franc, which is in profit. See this very nice trend line break. I'm expecting pound strength. The Swiss franc, I know it's going to be weak. Remember, back to my main screen. Remember what I'm going to do? A strong currency against a weak currency. I'm expecting the pound to be strong and the Swiss franc to be weak. Going back to the other screens, this is how you do it. And I've got a trend line break. So as long as I'm above that trend line, I'm long. Right, and I'm looking for a move back up to 1.29, 1.2950, and I'm already in good profit ahead of the meeting. Why? Because traders are buying the pound ahead of the meeting. The euro pound, I'm short the euro pound, and I shorted the euro pound from last week. I had Harami inside bar pattern. I had a bearish break. You've got a trend line, very simple short, got an easy target down to that 0.8500, already in decent profit ahead of the Bank of England meeting. I'm also long the pound yen. You can see approaching this key trend line on the monthly chart, a break at that level, and you're opening up the way to 157, 158. So I'm long versus 3 different instruments. I'm expecting weakness in the euro, weakness in the Swiss franc, weakness in the yen. So that's why I paired pounds, strength against euro, strength against the Swiss franc, strength against the Japanese yen. That's how it's done. Okay, and I've been anticipating this, and I've been buying the pound into the event. Now, when it comes to the event, I have a choice. I can maybe take half my position off and take profit and put the other half at break even. I'm in a risk-free trade. Or I can let it all run and go for the meeting. At the moment, I'm going to let it all run because I'm expecting, I'll show you why now. Let me teach you something. Now, these are called the Sonia futures, okay? Now, this is basically futures markets pricing interest rates for the Bank of England in the future. As these drop, that means that interest rates are expected to increase. Now, remember, the key relationship to understand, rising interest rates equals the pound strengthening. Now, let me explain to you. Let's take this purple line here. Do you see it's got a reading of 99.77? Now what you do is you take 100 and you subtract 100 subtract 99.77. Now, what do you get? You get 0.33. Now, you look at the current interest rate for the Bank of England, and using one of our partners' financial source, you can use this, and you can see Bank of England, the current interest rate is 0.10. So that means you've got 0.33 minus 0.10 means you have 0.23 left. Now that means that in between June 2020 next year, markets are expecting 2 10 basis points interest rate hikes. And if you go all the way out to 2023, notice this is 0.44. They're expecting 3 interest rate hikes in 2023. So what are futures traders expecting? They're expecting interest rate hikes. That's why we're seeing the pound appreciating into the event. See pound appreciating against the dollar, pound appreciating against the euro, against the Swiss franc, against the Japanese yen. Now, when we get to the event, what are we actually looking for? Let's go and have a quick look at a calendar, and I'll talk you through this. Let me just do this. Let me just change the filters. Let's just have a pound. Let's have all of those. There we go for this week. Right. Now, this vote here is how many people are voting to keep what's called the asset purchases the same. Now, asset purchases is just another way of saying bond purchases or easy money or monetary easing. So in other words, this is how much money the UK government is essentially borrowing. So the larger that is, the worse news it is for the pound. The smaller that is, the better news for the pound. So do they expect to keep the asset purchases the same or cut them? Now, I'm expecting this vote to go down to 207. So the numbers stand for how many people are in what's called the MPC, the Monetary Policy Committee. So I'm expecting 2 members, Andy Vliege, so Vliege and Andy Haldane, I'm expecting them to vote for asset purchases to be reduced. Then, how many people want to keep the interest rate the same? I'm expecting everyone to want to keep the interest rate the same, or it could be 108. Maybe Andy Haldane, who will vote for the interest rate to be hiked, or maybe an abstention. So the most bullish reaction is, say we got like 404 or 422. You'd expect to see a lot of strength in the pound. Say the asset purchases were cut from, say, 895, say they were cut to like 700 or 600 pound strength. If anyone voted for an interest rate hike, expect immediate pound strength. Now, what did the Federal Reserve do last week? They surprised markets, didn't they, by raising interest rates. The Bank of Canada, they surprised markets by easing asset purchases. The Reserve Bank of New Zealand, they surprised markets by bringing forward interest rate hikes early. Do you get the theme? Central banks are starting to surprise markets. Now, there's a lot of good reasons for the UK to surprise markets. One, inflation's quite high. The core inflation reading for the UK is 2%. Remember, the Federal Reserve were worried about rising inflation. The Bank of England might want to ease. They might want to act so that they ease back that asset purchase so they can address rising inflation. We are seeing some of the strongest growth in years in the UK as the economies get opening again. So-called Freedom Day is now set for the 19th of July, and there are rumours, and this is if hospitalizations and deaths can be minimised, that Freedom Day will be brought forward. The general markers in the UK economy is that, yes, the UK is expecting a robust and a strong recovery. So at what point do the Bank of England acknowledge it? Now, at the moment, you've only got Andy Haldane. Now, one of the key things you want to, when you're trading, is you want to know what these individual bank members are saying. So we have a resource here that gives us all the names of the MPC members, and you can see here Andy Haldane, and he's a hawk, right? Now Vliji is neutral, but he's made some hawkish comments. So at what point did these individuals change from being dovish to saying actually the situation has improved somewhat? You understand? So this is what I'm expecting. I'm expecting 7-2 vote tomorrow. Okay. So we could see a set, or maybe even a 6-3 vote. We could get Dave Ramsden leading that way as well. Now, this is what I'm expecting. A knee-jerk rally in the pound very quickly, and then, so I'd expect to see sudden downside. Let me just get the, sorry about that. Let me just get the right charts. Here we go. I expect sudden downside the euro pound, sudden upside pound Swiss franc pound yen, and then I wouldn't be surprised to see some of it pulling back. Why? Because Vliji and Andy Haldane are both due to leave the Bank of England. Their term is setting, and there's a new MPC member, Catherine Mann, coming in. So what I'm expecting is pound strength into the event, pound strength on the event, but then probably a retracement. Now, what would change my view is if we had something like a 5-4 view, anything like that, anything above 3. I'd expect that to change the outlook and to see some strength in the pound. Also, we'll be looking at the monetary policy summary to see what they say. Now, a good habit for you to get into is, if you really want to understand markets and how they work, is read the central bank minutes yourself. Now, all the central banks have their own website. You can go to their website and you can read the central bank minutes yourself. So for instance, with the Bank of England, all you do is you go to monetary policy, or go to just go to events, something like that. And you will have on your upcoming events, you will have the major events. You can use this to find out the releases as they come. And as those releases come, you can just literally read about them yourself. Monetary policy is essentially what you want, and you can read up about it, explain it, and then you actually read the report, and you get the publication and the speeches, and it'll pop up here on the feed when you get the actual meeting. Okay. And those reports, dead easy, and you read the minutes and the details for yourself. So we know what we're looking for now. We're looking for asset purchases to be cut, interest rates potentially be increased, and interest rate projections to go up. All of that should result in potentially the pound gaining into the meeting. Now, you don't want to buy the pound today unless you're taking a bit more of a risk, because prices moved a little bit. This is the sort of thing you want to do like the week before. A good opportunity. I was talking to a number of traders about 152 in the pound yen. That would have been ideal, coming in at 152. So you're with 300 points up in profit. So you don't want to be buying the pound yen at these rates, because this level is likely to cap prices, but you expect that to break out at some point. So that's really what we're looking for. Now, that's the Bank of England. There is another thing to be looking out for at the moment, and that is oil markets. Now, oil markets are really on a strong rip higher. Now, why? There's a lot of reasons. One, we're expecting more demand in the second half of this year. Two, there is a problem with supply. We're having significant draws in oil inventories. Thirdly, there is increasing legislation in the US against shale producers, and generally governments are becoming more and more anti-carbon burning of carbon fossil fuels. 4, OPEC Plus is controlling this market very well by limiting production. So medium term, oil buyers are expected. Now, I'll explain to you one good potential opportunity. Now, at the moment, there is talk about the US-Iran nuclear deal. If you're following the oil markets, you'll know about this deal. If that US-Iran nuclear deal gets agreed, you'd expect oil to instantly fall. There were rumors in the middle of June that the US-Iran nuclear deal was agreed. Okay, it wasn't. Now, why is that significant? If the US-Iran nuclear deal is agreed, it means all the oil that Iran is producing can officially come back into the market. Extra supply means prices should dip, but the environment is so conducive for oil that any dips lower in oil should fundamentally be considered reasons to buy. Now, where do you want to look at? You want to look at obvious places. So any retracement to that 68 level would be perfect on a weekly chart. And on an intraday chart, any retracement back down to that 7150 region can be considered a very good opportunity for upside in oil. Now, you see why, I always want to manage my risk. So a retracement to that trend line allows you to put your stop very tight just below there, 70 or 69. Okay, so if price moves down, you get stopped out, you lose your position, but then you can look at re-entering it somewhere else. So any move back down here, 7150, can be considered suitable for buying in the current market environment. But folks, does anyone have any questions? Don't forget, one of the key things about this workshop is for you to learn, ask questions. If there's anything you don't understand or want me to explain, just put it in the chat box or the question box. And I can help folks understand. Remember, don't forget to be following me at my Twitter feed. I put a lot of good information up here. And, I was talking about Bitcoin yesterday with Bloomberg, Ashrak. You can follow that here. And then talking to CNBC Arabia about, the path of the dollar. Is the super cycle, commodities dead? I was also speaking to a US journalist yesterday, the Washington Post, New York Times. So just follow me at Giles Cochran CCA. I put a whole great lot of information. Obviously, use my blog. I cover every single central bank meeting. I cover it here. You don't need to be in doubt, and I explain to you, what the significant shifts are. Yes, Syed. Thank you very much for your kind words, Syed. Yes. What's your perspective on gold? Excellent question. Do we hit the bottom after central bank interest rate decision, or fall will continue until we hit 1600, or will we see 1850 soon? Syed, a superb question. Now, thank you for raising that. Let me explain. There's one chart you need when you're trading gold. And I know, Syed, you'll be aware of this. Your question shows understanding about the interest rates. Now, when real yields move higher, gold moves lower. Now you say, what's a real yield? A real yield is this. It's the nominal bond yield minus inflation. So what's a nominal bond yield? Let me explain. Here is the nominal bond yield of the US 10-year. Now, do you see how it says 1.48? That's the yield, or if you like, that's the interest. So when you lend money to the US government for 10 years, they will give you 1.48% interest for every year you're lending them that money. So you can see here, you might think, well, that's great. Look, the yield of my bond is 1.48. Yes, but what is inflation? What is inflation? Because the yield is only relevant when you factor in inflation. That's the cost of goods and services. So if inflation is moving higher, then it will mean your nominal bond yield will be less value. And look here, we have inflation expectations. You can see inflation expectations have been rising. So you now go to your real yield, and you see that the real yield is your nominal bond yield minus inflation. And actually, the real yield of a US Treasury is minus 1.59%. So that means if you put money into a bond, you're actually losing value of money over time. Right. Now, when real yields fall, gold rises. So if real yields fall, gold rises. When real yields rise, gold falls. So Syed's question, for those of you who don't understand, is this: what's going on with gold now we've seen the US start to consider raising interest rates? To understand that, we need to go back to 2013. In 2013, the Federal Reserve started tapering bond purchases. In other words, they did something very similar to what they're doing now. Gold lost about 20% of its value. So you can understand, you can see the relationship. Rising interest rates means falling gold. So what Saeed's question is, where is gold going to go from here? Right, this is what I'm looking for. On Friday, we have the PCE core deflator, which is the inflation for consumers in the US. If that's very high, Syed, I expect gold to keep falling. If it's so-so, it could move up higher back to that 1830. Now, I sold gold out of the FOMC. I took profit around that 1760 level. Personally speaking, I'm looking to short gold back from 1830. I don't want to short gold here. It's too close to the recent lows. What's happening with US interest rates? What's happening with tapering? If bond tapering looks likely, more gold downside. If bond tapering looks unlikely, more gold upside. So that's basically what I'm looking at, Syed. At the moment, I think bond tapering is being anticipated at some point this year. So for me, gold is a sell on rallies. The ideal is a sell from that 1830 region with stops above 1920. Now, let me show you why. If you just put a fib retracement level, you'll see that that region is the 50% fib retracement level. You can see I've marked it here on my chart. And then if you look at the trend line on the monthly and the weekly, you'll see it nicely on the weekly. You see that very key trend line. We had a trend line break, broken, but a return to that trend line, I'm expecting to find sellers. So in 6 months' time, where do I expect gold to be? I expect gold to be around 1500, Saeed. Yeah. But I wouldn't be surprised to see a move higher in the short term, but I would be surprised to see gold going back above 1940. So I think it offers a reasonably good value. Now, what would change my view, Saeed? Remember, you never get married to a view. You have to be flexible. What would change my view is if the US economy started doing badly. If the Federal Reserve started saying we won't be raising interest rates, we won't be tapering bond purchases, and if inflation keeps rising, then I expect gold to rise with it. But Syed, essentially, you know, the two levels that you've marked in, I think, are significant and a good level. So excellent question. Shows understanding. And for those of you who maybe this is new to, remember, raising interest rates, the first step to raising interest rates is tapering bond purchases. So tapering bond purchases makes it fall. Oh, so that's excellent. And a great commodity to be looking at, Saeed. Really, you know, gold. I've been looking for this kind of, you know, that taper tantrum, and you know, a break of this triangle. So you could potentially open up some nice downside, you know, from a medium term. So look for a break of that trend line. I'd be interested potentially there. And on the weekly chart on Friday side, if we get the PCE is expected to come at 3.6%, which is hot. If it comes in even greater than that, I'd expect this to start moving lower. And if I started seeing this moving lower, anywhere near those lows, I'd expect to go with the break. So what another like way of managing this like intraday is get a break at this level, then look for a retest of 1760 to join it as a sell. But I don't like this region here, right? Because this is why I'm convinced at the moment that gold's going lower, okay? But one of the weaknesses with macro trading is that I'm still convinced that gold's going lower if it's at 1860, and I'm more convinced if it's at 1900. But I don't want to sit in all that drawdown. I want to get my entries right. You know, low drawdown, low stress, okay? I just had a bit of drawdown with a pound yen trade. I was long the pound yen from a while ago, and I had to sit through a bit of drawdown, and I hate it. So try to get into a good, try to enter places where you have low drawdown. Okay, and you can always re-enter. Super. Well, thank you all very much. Been an absolute pleasure as always. Don't forget, Mondays do come back here again. We'll do it all again. We'll get ready for the next week. Every Monday, live market, we look ahead. Any questions you've got, any trades you're thinking of, bring them to me. Happy to look at any currency pair, any instrument you're trading, and if there's any insight I can give, technically or fundamentally, you know, that's what I'm here to do. So folks, take care, have a very good afternoon, and I look forward to being scheduled back here on Monday. Take care and have a great weekend if I don't see you before. Thanks now, goodbye.